what surprised me, it opened 33 new depots last year. I thought the UK market was quite mature, bringing the UK total to 840. I mean, who would have thought it still had that ability to grow in the UK? And it opened 10 international depots, and it's in its infancy there, 65 trading in France and Belgium, and 10 in the Republic of Ireland. Or clearly, there's quite a lot of potential in France and Belgium if the model works. Great operating margins, 18%. And that key measure for investors, great return on capital and equity, 27% return on capital, 40% return on equity. So this is what people should be looking for. If you can reinvest at those high levels and supporting this kind of growth, fantastic.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Lovely to see you again.
Hi, Lee. Good as always.
Yeah, we missed last week's, unfortunately, because somebody was off having a lovely time skiing.
Yeah, I have to have a break sometimes. Have to have a break. Cut back and refresh, ready to go.
Agreed. We do all need a break sometimes. So, we've got another jam-packed episode covering another CMA review into the UK major house builders. We're going to cover Ocado, Howdens, British Airways, St James's Place. You've got a few thoughts on that one. Then on to AIM, as always, covering Tristel, Brickability, Kitwave and Avingtrans. But before we get into all of that, we're going to start off with Warren Buffett's annual shareholder letter, which has just came out a little over a week ago.
This is a must read for any investor, and I would implore anybody who's interested in investing to read that. I tell you what's really funny as well. Go on the Berkshire Hathaway website. What is it? The sixth, seventh largest company on the US stock market, I think, by market capitalization. Its website is like something out of the dark ages of the internet. It's absolutely cracking. Brilliant business. But all the facts are there, all the information's there, and you really should go and have a look at it. But Berkshire Hathaway's got 3 million shareholders, and this letter is read by millions of other investors. And there was a touching tribute at the start of it this year to former vice chairman of Berkshire Hathaway, Charlie Munger, who died not long ago. Warren referred to now as the architect of Berkshire Hathaway. He was really the creator and changed Buffett's mindset. But there were a few really interesting points from our perspective. Berkshire Hathaway's cash piles are up now at $168 billion at the end of 2023. Now, he doesn't know what to do with it. He doesn't know what to do with all this cash. He can't find opportunities to move the Berkshire needle now. It's very hard to find businesses that are big enough and appealing enough to them to invest in. So he can make small investments. And they're not going to move things. But really, we like this comment. I mean, everybody should listen to this comment. This is the most successful investor ever. Look at the returns he's generated for people, or he and the business and Charlie, his structure. But he makes this comment in the letter. Our goal is realistic. Berkshire's strength comes from its Niagara of diverse earnings delivered after interest costs, taxes, and substantial charges for depreciation and amortization. In brackets, EBITDA is a banned measurement at Berkshire. Thank you, Warren.
Chris, I would say that he's been listening to your podcasts.
I hope so. I hope so. I hope so. But yeah, it's worth following. The best investor in the world thinks it's rubbish, EBITDA. Why doesn't everybody else? They might see some benefit in their share price performance if they actually come clean with their numbers. Maybe their numbers aren't so good. That's the problem.
Yeah. Smoke and mirrors. Well, you mentioned there the companies he invests in. He holds a 5.9% position in Apple, slightly more than the cash that they have in the bank, $170 billion.
Yeah. I mean, for a guy it is. For a guy that sort of was somewhat tentative investor in technology companies, his biggest position by far is Apple. They still hold Coca-Cola and American Express, $170 billion position in Apple. And Apple reported this week that it's shutting down its electric vehicle project, which I think is interesting. If a business like Apple, which is brilliant at logistics, brilliant at outsourcing, brilliant at marketing and creation, is pulling out of its EVs, I think it's somewhat telling. And many shareholders, actually Apple shareholders, have expressed relief because this has cost them a lot of money, I think. We don't know how much, but they put a lot of money into this EV project, this secret EV project.
It's one of them. Is it they just found it too hard, or is that a signal to the EV market?
Evidently, I think they found it too hard. Elon Musk has said production's hard. Everybody seemed to think it was easy to suddenly release the next electric vehicle company, but it's mighty tough, as Apple is demonstrating as well.
Yeah. Should we move closer to home?
Yeah, UK main market. I think worth mentioning briefly, yet another Competition and Markets Authority review. There seem to be so many of these, and this time it's into the house building sector. Competition watchdog has launched an investigation to 8 house builders over whether they shared commercially sensitive information. This just goes on and on. Every single sector is having a CMA review at the moment, which clearly impacts the share prices. I'm not convinced about the benefits of many of these. Clearly, there's an issue with house building. Only about 250,000 homes were built across the UK last year, short of the target of 300,000 government target. That's been the case now for years.
Yeah, the government certainly seems to, or particular departments of the government seem to be doing an awful lot of investigations into not just sectors, but individual businesses as well. Close Brothers is going through one at the moment, as is.
Jarvis Investment,
Yeah.
they are having that's a Section 166 review, skilled persons review. Yeah, a lot of financial services businesses have that as well. The Financial Conduct Authority and is concerned about interest income. But today, another stock that Associated Business holds shares in, CVS Group, the veterinary group, all the veterinary services sector subject to review as well. And that's depressing the share price until the outcome of the review's out. The share's been languishing. It's quite frustrating, really. I'm not quite sure hopefully this will be beneficial to the consumer, but in some places, I'm not convinced.
I suppose on the flip side of that, it may well provide an opportunity, depressed share prices for a good company that may well come out on the other side. Absolutely nothing wrong and a
Yeah,
good
it's
from the
absolutely.
CMAs.
CVS is doing very well. Double-digit top-line growth reported. It looks in good shape, and it's trying to keep away from the CMA by actually expanding in Australia. You can't get further away than that, can you? But it's buying a practice in Australia, so it's keeping out of the eyes of the CMA. And when it does buy businesses in the UK, it's going to the CMA and say, "Look, you okay with this? Can you sign it off?" That's what it's been doing. But yeah, it could be an opportunity. Good business, lots of cash flow. So CVS worth looking at as well because of that.
Yeah, we'll contrast that with one that still isn't yet making a profit, and that's Ocado.
Yeah, Ocado is interesting. It had its own it's got its own direct retail operation, but this is more about its technology. This business, I don't know when it ever will make a profit, and its cash outflow last year was 473 million. The offering's great. It's got cash just shy of 1 billion, so it's clearly got the resources, but if it keeps incurring outflows of this magnitude, it's going to need more funding. But yeah, good offering, but at some point, these businesses have got to wash their face, and Ocado's still a struggle. It has this deal with Marks and Spencers as well. It's restructuring that. So it seems to be doing fine. But finally, it's been around for quite a long time now. Can it actually make some money?
So is Ocado trying to position itself as a technology company that sells fruit and veg, or is it a supermarket?
It's hardly a supermarket because it doesn't trade on the rating of a supermarket. And this was the argument. It calls itself a technology company. I don't know. I
Yeah.
really don't know. But it definitely straddles different sectors. Investors have to have a sort of leap of faith, I think, and be quite creative in their thinking as to how it's going to really perform. The shares have fallen off as well, and I think people are viewing it differently now. In the boom times of technology, it commanded this great rating. That's over. Come on, we
Yeah.
need to make money sooner or later, folks.
It just needs to add AI somewhere in its bio or in its name.
Oh, it's
Be
deal
fine.
done, isn't it? It's
Yeah.
flying, flying.
And Currys rejects proposal from Elliott.
Yeah, Curry's, retailer formed from a merger of Carphone Warehouse and Dixon's years ago. It's rejected another offer from US investment group. Curry's has been struggling. It's one of those business, tiny margins, clearly impacted by consumer downturn. It's got some debt as well. But yeah, Elliott advisors come in with a deal. Management says it's still significantly undervalued. Watch this one. Watch this space. See what happens. I suspect there'll be other offers coming in.
And who knows what may result of that. They could turn the business around because there was a business that came from a collapsed consumer goods company of MFI, which we're going to come on to now, isn't it? Howdens, which is doing really well.
Yeah, I think it's a really lovely business, this. And the shares have performed particularly well in a horrible sector. Everything facing construction material has been dreadful. But Howdens Joinery, which supports the contractors, it's pretty good. Revenue was flat at 2.3 billion. It's just announced results. Cash is still flowing. And what really surprises me, I thought this business was pretty mature. And as I say, it was really born out of the ashes of MFI as a division of that, and has subsequently done really well. But it's what surprised me, it opened 33 new depots last year. I thought the UK market was quite mature. bringing the UK total to 840. I mean, who would have thought it still had that ability to grow in the UK? And it opened 10 international depots, and it's in its infancy there, 65 trading in France and Belgium, and 10 in the Republic of Ireland. Or clearly, there's quite a lot of potential in France and Belgium if the model works. And it's loads of investment. It's introduced 23 new kitchen ranges, launched a new paint-to-order service, upgrading manufacturing operations. And this business, after it invests a lot, great operating margins, 18%, and that key measure for investors, great return on capital and equity, 27% return on capital, 40% return on equity. So this is what people should be looking for. If you can reinvest at those high levels and supporting this kind of growth, fantastic. And, who would have thought in the troublesome market that this business could still be doing so, relatively well?
And don't quote me on this, but I think Howdens was one of the first major companies that brought to market pre-built kitchen carcasses. Until Howdens, it was all flat pack. So it used,
Right,
used to take the joiner an awful lot of time to actually put the carcasses together and then install the kitchen. Howdens delivered them pre-built. So you just literally push the carcass against the wall and screw it to the wall.
That's interesting. That's
Yeah.
really good. That's really
Yeah.
good. So they clearly got an eye for
Innovation,
albeit
innovation.
simple innovation,
Simple,
but it's innovation. Yeah.
It made a big difference, and it helps them a big share of the market in that
Yeah,
period.
no, it's good. It's
Because it
good.
was
No, they're well liked, aren't they? And they've supported the industry, haven't they?
Yeah.
They've supported those joiners. They've supported the installers,
Yes.
which has been key.
Yeah, and they're the ones who are going out pricing the jobs up.
Absolutely, absolutely.
so
They're
they're the
your
ones-
salesman out
They're
there
the
on the
salesmen
street,
out
in the
there on the
market.
street.
Yeah.
Yeah. Another one that's doing nicely, which kind of dovetails into Jet2, which we've mentioned, which is British Airways, and it just demonstrates that the airline industry and travel industry is actually doing better than what most people think.
Yeah, announced results, revenue up 27% to 29.5 billion. These are quite big numbers. Operating profit 2.3 billion higher. Clearly, it's coming off quite low comparisons, but passenger capacity was up, benefiting from leisure travel, more long haul than Jet2. And management said clearly consumers are continuing to prioritize travel. They want to get away, and British Airways is there to help them. British Airways more longer transatlantic routes rather than Jet2. It's more sort of European sun. But yeah, both we continue to like Jet2. Great service proposition, which I think has gone down very well.
Like we mentioned on the last one, I think we underestimate the desire for the British public to get away on a holiday.
Yeah.
I think the desire to get on holiday outweighs money in other areas that they can
Absolutely.
put back on.
No, it does. I think
I
it's
really
spot
do.
on. Spot on.
Yeah. And given it the week that we're in, no podcast about the news on the markets would be complete without discussing St. James's Place. So finally, things have caught up with them, shall we say.
I totally agree. You've hit the nail on the head. Their results are, we referred to an investor champion, gobbledygook. I ask anybody to have a look at these. Even when we look at a lot of company results, and these things are unfathomable. You've really got to have specialist knowledge. Why they can't, first of all, present their results more clearly, I think it's probably that's indicative of how they've been supporting their clients. They're going to spend 2 to 3 years now to settle issues with potentially overcharging or people they shouldn't charge. Some of the terminology as well they use. Ongoing service evidence provision. What does that mean? This business has a reputation for very high charges. Everybody in the industry's known it. And questionable structure of charging. Clients being charged high initial fees to support their very, shall we say, able salespeople stroke advisors out in the field who are very well remunerated for bringing in the business, but that's at the expense of the clients. I think clients are paying very dearly for a decent lunch or two or special event each year, and the penny has finally dropped, and not before time. I think, but look at this kind of reporting. I think they should start here and start being plainer at how they explain things. We also get the bizarre term of European embedded value, which supplements their statutory results. I find it's a minefield, I can tell you.
Do you think this is a bit of a seismic shift in the industry?
I hope so.
Or do you think
This is
St.
a
James-
big business. It's not a small business.
Do you think St. James is just a bit late to the party and many of the other companies are already ahead of the curve in terms of fees and remuneration and things like that?
No, I think a lot of other businesses are going to be caught out. We live in a world now with fairly cheap, so we say low cost investment products. There's been a drive to indexing and low cost, many of which are really excellent for your average investor and can form the basis of any person's investment portfolio. So things haven't got to be complicated unless you want specialist tax-related services, a bit like the AIM service that we have. So there's really the costs have dropped materially. I just think everybody needs to be more open in their charging structure. And these people have been getting away with, quite frankly, daylight robbery for years. As I say, often hidden in some more lavish add-ons that they're giving to their clients.
Yeah, the market must have been onto it because at the end of 2021, their share price was above 16.50, and as of last week, it dropped below 500. So in a very
Yeah,
short period of time, they've lost
they
share
have. Well,
value.
I think they lost £1 billion on the day of the results this week. It's not good. I question what other skeletons they'll find in their cupboard, especially given the unusual nature of their reporting. But yeah.
Has this been driven by the FCA or the government, or who's driven this kind of opening up of the
Government and directly FCA, and it's
FCA?
all built around the consumer duty and the requirement for value for money as well that is trying to be instilled in these businesses. And they won't be alone. There'll be others that are coming under scrutiny as well. And as
No.
I say, not before time. But yeah, I think St James's Place has always, as you alluded to, also had a reputation for high charging and for what added benefit. I think that's got to be. There's got to be, if you charge, there's got to be some benefit or justification for the work being done. But I think, and these exit penalties as well. Effectively, to my knowledge, advisors were being advanced commissions for bringing in business, and the security of that was around if the clients leave, they will be effectively charged an exit penalty, which that's unheard of nowadays. You're not charged exit penalties to move your money, are you?
No, yeah, that's yeah. But perhaps maybe this is one government investigation that is proving fruitful for consumers. So maybe them going after
Yeah,
other
it's,
industries and other businesses is, I suppose, what it will do is it will give those companies and industries a clean bill of health.
yeah, absolutely, absolutely.
Shall we continue the theme of our luxury goods?
Absolutely. We
With
like
it?
our luxury goods. For one luxury good announced today, or is it an automotive business or is it a luxury goods? That was Aston Martin Lagonda announced this week. Its sales rose 6,600 vehicles, revenue rose to 1.6 billion, but losses here we again reduced to 240 million. This business has never made a bean in living memory, as far as I'm aware. And I think its concern is returning to a luxury thing. I don't think it's luxurious enough. The average sales price of its cars rose 6% to 188,000, but that's under half the sort of average sales price achieved by Ferrari. And Ferrari is the pin-up poster child of luxury automotive. Ferrari's business, go onto our Investors Champion site and read the comparison to Ferrari. Their numbers are absolutely staggering. And I would also implore people to read Ferrari's annual report, which is out, because it is absolutely a blueprint for luxury goods. It's all there. It shows all the breakdown, their activities, where they're moving, their ideas. It's really interesting stuff. I don't look a good through it. It's quite a few pages, but really worth a look to get an idea of positioning in luxury goods or luxury goods and automotive. So maybe there's hope for Aston Martin Lagonda if it can emulate that and lift its pricing, because the brand is quite iconic. But I haven't got a clue how you value it. It's valued at the moment at 1.5 billion. It's never made any money. It's got loads of debt, living on the James Bond kind of image, isn't it?
Yeah, definitely. When you think of Aston Martin, James Bond springs to mind, doesn't it? But yeah,
Which is perhaps ironic. It lives in the kind of fictional world, and whereas Ferrari its imagery has been in the real world, a real history and heritage and brand status. Maybe that's Aston Martin's inherent problem. It's never lived in the real world.
yeah. Maybe its cars are just too cheap, as you say. Maybe they just need to raise the
You've
prices.
got to keep adding those extras.
Keep adding those extra zeros.
Yeah.
Shall we move on to AIM then?
Yeah, absolutely. AIM. So there's been loads of news again. Briefly, Tristel, manufacturer of infection prevention products. Great results, doing really well. The problem, the shares are very expensive on many levels, but big opportunity in the United States. It's received its approvals to sell its stuff in the States. It's got a nice partner out there, and it could do nicely if it really flies in the States. But revenue rose 20% last year to 21 million. For the 6 months. And overseas sales were up 13%. If it can fly, it'll justify that quite high rating, but worth keeping an eye on. But it looks a bit pricey to us.
Yeah, potentially a big market for it if it can execute.
Huge. Yeah,
That's the question, isn't it?
yeah, absolutely.
Can it
Absolutely.
execute?
Can it execute? And what will incumbents do in that market? Tough to break in. Supposing that what will rivals say, hold it, we're going to start competing a bit harder on price and things. How easy will it be? tough to break into the US.
Yeah. But hopefully it will, and it can be a nice little success story. British company doing well in America. And Marlowe has announced the sale of one of its divisions, but all is not what it quite seems, is it?
Yeah, Marlowe has announced the sale of one of its divisions for a big price, and its shares rose 30 odd percent, but they've been pretty depressed lately. And Marlowe's been hugely acquisitive. I mean, it describes its activities in business critical services and software, which assure regulatory compliance. And it covers countless seeming markets: governance, risk, testing, inspection, certification, e-learning, everything. It started off in one area. It's bought loads of software businesses as well, and the software bits it's sold. But its acquisitions, 80 acquisitions in 8 years, and 36 in the last three. That sounds crazy for a small company to manage those and effectively integrate them. And everybody's come on and said, whoopee-doo, we've sold this business for a big premium and now going to return money to shareholders with the excess cash. And the share price now is at pounds. If they're returning money to shareholders at £5, having raised money from shareholders at prices as high as £9, I think they raised, so they're talking about returning 150 million to shareholders, but they raised previously 150 million from shareholders at average prices about £7.50 odd, something like that. I'm a simple soul, and that doesn't hang with me. So,
The maths don't work out.
oh, well, we've always thought these manic acquisitions, the stock market is all about kidology a lot of the time. You've got to convince people. And Marlowe done a great job of convincing people that they have some wondrous strategy. I'm not convinced because it doesn't look terribly wondrous to me, just making lots of random acquisitions.
Yeah.
But they managed to get off the hook with this one. The CEO is moving with the business sold to the private equity buyer. So he's been the architect of this thing, and he isn't left with the remainder. And who knows the worth of the remainder? It'll be quite interesting to follow how they get on.
Yeah. I suppose perhaps maybe when they hatched the idea with the original strategy, they probably believed and thought it could well work what they were embarking on. But then the reality of it hit 6, 7, 8 years later. Now we've got all these acquisitions dotted all around the country. We're having to try and integrate them, which is a huge mammoth task, isn't it? Even
For any small bit, and probably people businesses as well. It's not like you've got a single product. People business is tough.
yeah, very tough.
But they
Very
seem
tough.
to have gone one direction, then they thought, oh, all the money's in software, we go there, which has proved to be correct. Look, they've sold the software businesses for decent money. But to say that significant shareholder value has been created at this point
Yeah.
seems, from our perspective, a little bit rich. We've still got a business left. It'll be interesting to see how that gets on.
And I'm sure the CEO has his reasonings for going to the private equity side of it.
Sells a great story to the investor base, goes in and sells a great story. Kidology.
Kidology.
Magnificent.
A company that perhaps doesn't engage in kidology and is a pretty boring business, Brickability.
Yeah, it's construction materials sector, so it's had its struggles. But we like the fact here that the CEO's retiring, the sort of architect of things, and unusually for his retiring CEO, he's been buying up loads of shares. Normally they're looking at ditching their shares. Well, this Alan Simpson has been buying up lots of shares. We hold Brickability, and the Fundamental does in their AIM portfolios, a small position, and we like commitment from CEOs. What it's all about. They should be making these kind of commitments, and Mr. Simpson has certainly been doing that, which is good to see.
Yeah, and I guess you contrast that with the other CEO who's leaving Marlowe to the private equity side of things.
I don't think he's put his hand in his pocket to the same extent as Mr. Simpson. I think he's used the market in a less risky manner, shall we say. But I don't know the specifics.
Yeah. And another company that you do hold in the fundamental asset portfolio that's Kitwave.
Yeah, we've been buying into it recently. It hasn't been a long-term holding, but it's done brilliantly. It's what you would sort of refer to it as a boring business. It does wholesale distribution to 40,000 plus convenience stores and from, I think, 30 odd depots around the country. It started in 1987 from a single site confectionery wholesale business in North Shields. It's done brilliantly. Again, CEO of Kitwave's retiring as well, the co-founder of the business. And you've got to really know what you're doing to have this kind of network and make it work. And Kitwave's been a great IPO since 2021, a rare IPO success. So hats off to them, growing strongly, using cash to buy more businesses. They think there's a big opportunity still. It's not for everyone. Tiny margins on quite big revenue. So not for everyone, but very efficiently managed in our opinion, and worth a look at, keep a look at. Nice dividend as well.
Just curiosity here. Say the founder's retiring. Who's taking over? Who's going to be?
COO is taking over, who's been there also some time as well. So they're keeping it in the family, so to speak. But yeah, I think it could hopefully be an easy transition.
You're happy with that transition
Absolutely.
as a shareholder?
Absolutely. For the time being, see how he gets on.
And founded in 1987 as well.
Yeah. Look, it's taken a while, and they've done a few deals since listing in 21. But I think it's been a good route for them. The listing has been an exit for the founder. He sold some shares when they first came onto the market. The backers or private equity backers sold some as well, and now he's moving on. So good stuff.
I like seeing that when you see a company that's got some age to it, because they've been through a lot of cycles. They've seen the highs and the lows. They've been through all the fear that we constantly see on the news every day, and they're still here and they're doing well.
Yeah, absolutely.
And a company as well that's had a value but full of potential, and that's Avingtrans.
Yeah, Avingtrans is an engineering group, and it's got its core engineering business. It supports the nuclear sector, nuclear decommissioning, and that's highly profitable and doing nicely. The problem is Avingtrans is using the profits effectively from one to fund a newer, more nascent business in medical imaging and X-ray. We don't hold the shares, but management pretty shrewd here. They call it, it's got a good track record of acquiring, improving, and subsequently disposing of operating companies. It calls it its pinpoint invest exit strategy, PI, in Avingtrans language. It's sort of parceled up these two things. Its engineering is one division, and its medical imaging bit is and industrial imaging is the other. That seems to hold great potential. It's got some new technology. It's investing in it. And the problem is very hard to value. On isolation, the valuation looks really rich based on the net returns, but one's returning big profits, and the other bit's losses. So it's really masking the reality of what's going on. But it's an example of you've got to dig into the detail to understand the business. On isolation, the shares trade at, 130 times forecast earnings, which looks crazy. But take out the medical bit, and it's actually only trading at 10 odd times, 12 times earnings. Interesting one to look at, and worth digging, as I say, into the detail of that one. I must admit, we have had limited success with engineering companies. We've had one very good one that's this very specialist engineering company called AB Dynamics Automotive Engineering. Lovely little business. It announced recently as well. Quite a high valuation, but produces automotive testing equipment. But we've had other less rosy experiences in the engineering sector. But yeah, if specialist engineers can command high ratings, they're terrific businesses. AB Dynamics was very special. Nobody was interested in it when it first listed, but suddenly it proved to be a little gem.
Yeah, perfect. Shall we leave it there?
Yeah, that's excellent. You can find out more on the Investors Champion site. There's plenty of commentaries, plenty more detail.
Yes, as always, all the links will be in the show notes just below.
Great.
Cheers. Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics, and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.